What if I told you that the biggest threat to Bitcoin right now isn't hackers, governments, or even retail investors, but the banking system itself? Today, we're going to talk about why banks may be quietly pushing Bitcoin into what some are calling a death spiral. Now, before you panic, this is not a Bitcoin is dead video. Instead, we're going to break down what's actually happening behind the scenes. How liquidity, leverage, and institutional pressure play a role, and most importantly, what this means for you as an investor. Because markets don't crash from fear alone, they crash when systems are stressed. Let's get into it. Right now, Bitcoin is under pressure, and not because anything is broken in the technology, but because the environment around it has changed in a way that makes survival harder for all risk assets. To understand this, you have to zoom out and look at liquidity. Bitcoin, despite the narrative of being independent from the traditional system, still trades inside a global financial ecosystem that is heavily influenced by banks, interest rates, and access to cheap money. When liquidity is abundant, capital flows freely into assets that promise growth, innovation, or asymmetric upside. Bitcoin thrives in that environment. When liquidity dries up, the opposite happens. Banks today are far more cautious than they were just a few years ago. Higher interest rates mean borrowing money is expensive. Credit standards tighten, lending slows. Capital becomes selective. In this type of environment, banks are not incentivized to support speculative or volatile assets. Instead, they prioritize balance sheet strength, regulatory compliance, and capital preservation. That shift alone creates downward pressure on Bitcoin, not because banks are directly attacking it, but because they are no longer feeding the conditions that allow it to rise. Bitcoin is particularly sensitive to this because it doesn't generate cash flow. It doesn't pay dividends. Its value is largely driven by demand, confidence, and the availability of capital willing to take risk. When institutions and investors start pulling back, ebbing slightly, that demand weakens, prices fall. As prices fall, sentiment worsens. And when sentiment worsens, marginal buyers disappear. This creates a feedback loop where declining prices reinforce declining confidence. Another layer to this pressure comes from leverage. Over the past decade, Bitcoin's growth has been amplified by leverage across exchanges, funds, and institutions. When liquidity tightens, leverage becomes dangerous. Positions that once looked manageable suddenly require more collateral. Margin calls happen. Forced selling begins. And forced selling has nothing to do with belief in Bitcoin's long-term future. It's mechanical. Assets get sold because they have to be sold. Bitcoin, being highly liquid and tradable 24/7, often becomes the first thing to go. Banks also play an indirect role through custody, payment rails, and market infrastructure. When banks reduce exposure to crypto-related businesses or make it harder for money to move in and out of the system, friction increases. Friction discourages. Friction discourages participation. Fewer on-ramps mean fewer new buyers. Even long-term holders can become hesitant when access feels uncertain. None of this kills Bitcoin outright, but it slows momentum at the worst possible time. The result is what feels like constant pressure. Every rally gets sold. Every piece of good news fades quickly. Volatility increases, but upward follow-through disappears. This is what people describe as a death spiral. Not because Bitcoin is literally dying, but because the forces acting on it are compounding. Less liquidity leads to lower prices. Lower prices lead to weaker sentiment. Weaker sentiment leads to less demand, and less demand reinforces lower prices. What makes this moment especially uncomfortable is that Bitcoin's narrative clashes with reality. It's supposed to be a hedge, a safe haven, an alternative, but in practice, markets treat it like a high-risk asset when fear rises. That contradiction shakes confidence, especially among newer investors who haven't lived through multiple cycles. They see banks tightening, prices falling, headlines turning negative, and they assume something fundamental must be wrong. In reality, what's happening is structural stress, not failure. Bitcoin is being tested in a hostile financial environment where capital is scarce and caution dominates decision. Whether it emerges stronger depends less on ideology and more on time, patience, and the eventual return of liquidity. But in the short term, the pressure is real. And pretending otherwise doesn't help investors understand why Bitcoin feels so heavy right now. Banks may be accelerating Bitcoin's decline not through a coordinated attack, but through a series of rational decisions that collectively create pressure on the asset. At the center of this issue is institutional exposure. Over the last few years, Bitcoin quietly became embedded in the traditional financial system through hedge funds, publicly traded companies, custodians, lenders, and structured products. This integration brought legitimacy and capital, but it also tied Bitcoin's price more closely to the health and behavior of institutions that operate under strict rules and constraints. When banks and large financial entities face stress, their first priority is survival. That means shoring up balance sheets, reducing exposure to volatile assets, and ensuring they meet regulatory and liquidity requirements. Bitcoin, regardless of its long-term potential, sits firmly in the category of high volatility, non-essential assets. So when pressure builds, it becomes a candidate for reduction. Not because institutions suddenly lose faith in Bitcoin, but because they need cash, stability, and predictability. This is where the decline can accelerate. Institutions often hold Bitcoin in size. When even a small portion of those holdings is sold, it can have an outsized impact on price. Retail investors tend to think in terms of belief and conviction, but institutional selling is rarely emotional. It's systematic. Risk models change. Exposure limits are adjusted. Asset allocations are when Bitcoin falls below certain thresholds, automatic selling can be triggered, adding downward momentum regardless of broader sentiment. Companies that have leveraged Bitcoin holdings are particularly vulnerable in this environment. If a firm borrows against Bitcoin or uses it as a core treasury asset, falling prices can quickly become a problem. Collateral values drop, loan-to-value ratios worsen, creditors demand more collateral, or at that point selling Bitcoin becomes less of a choice and more of an obligation. These forced actions are powerful because they happen during weakness, not strength, intensifying declines rather than stabilizing them. Banks also influence Bitcoin indirectly through the broader credit environment. When credit tightens, speculative activity shrinks. Funds that once used leverage to amplify returns are forced to delay. Market makers reduce exposure. Liquidity providers step back. With fewer participants willing or able to absorb selling pressure, prices move faster and more violently to the downside. Bitcoin's 24/7 liquidity makes it easy to sell at any time, which ironically makes it more likely to be sold first when stress appears. Another factor is reputational and regulatory risk. Banks are highly sensitive to scrutiny. When regulators signal concern about crypto exposure, even subtly, banks respond conservatively. They may limit services to crypto firms, reduce custody support, or slow transactions related to digital assets. These actions don't ban Bitcoin, but they create friction. Friction increases uncertainty. Uncertainty discourages capital. As participation drops, demand weakens, reinforcing the price decline. This environment creates a reflexive loop. Falling prices make Bitcoin look riskier. As it looks riskier, institutions reduce exposure. As exposure is reduced, prices fall further. Each step is logical on its own, but together they can resemble a spiral. Importantly, this spiral is driven by structure, not sentiment. It doesn't require widespread panic or negative headlines. It only requires institutions to follow their risk management playbooks. Retail investors often misinterpret this process. They see institutional selling as a loss of faith or a signal that something is fundamentally wrong. In reality, institutions may still be bullish long-term, but unable or unwilling to endure short-term volatility in a constrained environment. Time horizons shorten when balance sheets are stressed. Optionality becomes more valuable than conviction. Cash becomes king. What makes this dynamic especially difficult is that institutional selling tends to be invisible until after the fact. By the time disclosures are made or positions are reported, the price impact has already occurred. Retail investors are left reacting to price movements without understanding the mechanical forces behind them. This fuels fear, which adds another layer of selling pressure from individuals who assume they are late to bad news. The result is a market where downward moves feel sudden, relentless, and disproportionate to any single event. Banks are not pushing Bitcoin down out of malice, but through risk reduction, deleveraging, regulatory caution, and the need to prioritize stability over speculation in an environment where uncertainty dominates capital decisions and liquidity is no longer taken for granted. Fear in the crypto market doesn't arrive all at once. It builds quietly, layer by layer. As prices slip, volatility increases, and confidence erodes. What makes Bitcoin especially vulnerable to this process is how closely perception and price are linked. Unlike traditional assets that can lean on earnings, dividends, or tangible cash flows, Bitcoin relies heavily on collective belief, network confidence, and expectations about the future. When those expectations begin to wobble, fear has room to grow even without a single catastrophic event. The first signal of fear is usually price behavior rather than headlines. Bitcoin starts making lower highs. Rallies feel weaker and shorter-lived. Selling pressure appears faster than buying interest. For many investors, this subtle shift is more unsettling than a sharp crash because it suggests exhaustion. When every bounce is sold in two, people begin to question whether demand still exists. That doubt spreads quietly through the market, especially among participants who entered during more optimistic conditions. Volatility then adds fuel to the fire. Larger intraday swings create emotional stress. Investors check prices more frequently. Small losses feel bigger when they happen quickly. This constant movement creates a sense of instability, even if prices are not collapsing outright. Humans are wired to respond to uncertainty with caution, and in financial markets, caution often translates into selling or stepping aside. As more participants hesitate to buy, liquidity thins, which makes each price move more dramatic, reinforcing the feeling that the market is fragile. Social feedback loops play a major role in amplifying fear. Crypto is heavily influenced by online discourse, and sentiment spreads rapidly through social media, forums, and comment sections. When prices fall, narratives shift. Optimism gives way to skepticism. Long-term arguments are replaced by short-term warnings. Influencers become more cautious. Charts dominate conversations. This collective change in tone signals to investors that something is wrong, even if the underlying fundamentals have not materially changed. As fear builds, time horizons shrink. Investors who once talked about holding for years start thinking in weeks or days. Every price move is interpreted as a potential signal. This short-term focus increases reactivity. Instead of asking whether Bitcoin will matter in 5 or 10 years, people ask whether it will be lower tomorrow. That mindset makes markets more fragile because it prioritizes immediate safety over long-term conviction. Another key component of fear is uncertainty about who is selling and why. When prices fall without a clear explanation, investors fill the gap with assumptions. They imagine insiders exiting, institutions abandoning positions, or unseen risks emerging. The lack of transparency fuels anxiety. Bitcoin's global, decentralized nature means there is no single source of truth during periods of stress. This ambiguity allows fear to grow unchecked, because uncertainty is often more frightening than bad news. Fear also feeds on loss aversion. Many investors experience pain from losses more intensely than pleasure from gains. As Bitcoin drops below key psychological levels, those who bought higher feel pressure to act. Holding becomes emotionally taxing. Selling offers relief, even if it locks in losses. When enough people choose relief over patience, selling pressure increases, pushing prices lower and validating the fear that triggered the behavior in the first place. Over time, this creates a self-reinforcing cycle. Falling prices generate fear. Fear reduces buying and increases selling. Reduced demand leads to further price declines. Each step appears rational from the perspective of an individual investor trying to manage risk, but collectively, it drives the market deeper into weakness. This is how sentiment can become detached from fundamentals, allowing emotion to dominate. What makes this phase especially challenging is that fear often peaks before clarity returns. By the time risks are fully understood or conditions stabilize, many investors have already exited. They look back and realize they sold not because they had new information, but because the environment felt uncomfortable. In crypto, discomfort spreads faster than facts, and when fear takes hold, it doesn't need confirmation to persist. It only needs movement, uncertainty, and enough people watching the same price chart, reacting in real time to each tick, each headline, and each rumor, allowing emotion to quietly reshape the market from the inside. The idea that this moment represents the end of Bitcoin is emotionally compelling but historically inconsistent. Bitcoin has repeatedly faced periods where its survival was questioned, often during times of macroeconomic stress, regulatory uncertainty, or sharp market drawdowns. Each time, the narrative of collapse felt convincing because the conditions were hostile and the price action reinforced pessimism. What matters in these moments is separating cyclical pressure from structural failure, because the two can look identical in the short term. Bitcoin operates in cycles largely driven by liquidity, adoption waves, and shifts in market psychology. When liquidity is abundant and risk appetite is strong, capital flows into Bitcoin aggressively, pushing prices higher and attracting attention. When liquidity contracts and caution dominates, that same capital retreats, exposing Bitcoin's volatility. This pattern is not unique to Bitcoin. It applies to many emerging or growth-oriented assets. The difference is that Bitcoin's transparency and constant trading make these cycles more visible and emotionally intense. Despite current pressure, the core attributes that define Bitcoin remain unchanged. The supply is still capped. The network continues to function without interruption. Transactions settle globally without centralized control. These characteristics do not disappear during bear markets. They simply become less exciting when price appreciation slows or reverses. Long-term value propositions tend to fade into the background when short-term performance dominates attention, but that does not invalidate them. Another reason this phase is often misinterpreted as permanent decline is recency bias. Investors naturally overweight recent experiences when forming expectations about the future. When prices fall for an extended period, it feels like the new normal. Optimism from prior cycles is dismissed as naive. However, history shows that prolonged consolidation and drawdowns have been common in Bitcoin's evolution. Periods of stagnation have often preceded renewed growth, not because of hype, but because infrastructure, understanding, and adoption quietly improved while speculation cooled. The role of banks and institutions in this context is also nuanced. While they may currently be reducing exposure or tightening involvement, their presence alone signals that Bitcoin has moved beyond the fringe. Institutions do not engage with assets they consider irrelevant. Their cyclical participation reflects risk management, not a verdict on long-term viability. Institutional capital tends to be opportunistic, entering during favorable conditions and retreating during stress, then returning when the environment improves. Bitcoin's resilience is rooted in its decentralized nature. There is no central company to go bankrupt, no executive team to resign, and no single jurisdiction that can shut it down. This makes its failure mode different from traditional assets. Declines in price do not directly impair the network's ability to operate. Miners adjust, difficulty recalibrates. Activity continues. This separation between market value and operational function is critical to understanding why Bitcoin can endure prolonged periods of pessimism without breaking. Adoption also tends to progress unevenly. While speculative interests may decline, use cases often continue developing in the background. Infrastructure matures. Regulatory clarity improves incrementally. New participants learn from past excesses. These developments rarely make headlines during downturns, but they lay the groundwork for future cycles. By the time sentiment shifts, much of the progress has already occurred quietly. What distinguishes this moment is not that Bitcoin is weaker than before, but that expectations were higher. When expectations are inflated, reality feels disappointing, even if fundamentals are intact. This gap between expectation and reality fuels narratives of failure. Over time, as excess leverage is cleared and speculative behavior fades, markets tend to find equilibrium. That process is uncomfortable, slow, and often misinterpreted as decline. Bitcoin does not need constant growth to survive. It needs time stability and continued participation from those who understand its long-term role. Markets move faster than fundamentals, and during periods of stress, price often leads perception in the wrong direction. What looks like the end is often a reset, where noise fades, conviction is tested, and the asset's underlying strengths are revealed, not through excitement, but through endurance in an environment that rewards patience over certainty. In moments like this, the most important decision an investor makes is not about predicting the next price move, but about how they respond to uncertainty. Volatile markets have a way of pulling attention towards short-term outcomes, encouraging constant monitoring and emotional reactions. When prices fluctuate rapidly and narratives turn negative, the instinct is to act, to do something, because inaction feels risky. Yet in investing, unnecessary action during periods of stress often creates more damage than the market itself. The first step is understanding personal risk tolerance. Many investors discover their true tolerance only when markets turn against them. Assets that felt comfortable during uptrends suddenly feel overwhelming when prices fall. This doesn't mean the investment thesis was wrong, but it may mean position sizing was. Aligning exposure with emotional and financial capacity is critical. An investment that causes constant anxiety can lead to poor decisions, regardless of its long-term potential. Managing risk also means acknowledging that uncertainty is not a temporary anomaly but a permanent feature of markets. There is no point at which all risks disappear. Waiting for perfect clarity often results in missed opportunities or reactionary decisions made too late. Instead of trying to eliminate uncertainty, disciplined investors learn to operate within it, using strategies that reduce the impact of being wrong rather than attempting to guarantee being right. Avoiding panic selling is less about stubbornness and more about preparation. Panic happens when outcomes violate expectations. Investors who mentally prepare for drawdowns are less likely to be surprised by them. This preparation includes understanding historical volatility, recognizing that sharp declines are part of Bitcoin's behavior, and accepting that temporary losses do not automatically invalidate a long-term thesis. Selling in panic often locks in losses at the very moment when risk is already priced into the asset. At the same time, discipline does not mean blind holding. Investors should continuously evaluate whether their original reasons for investing still apply. This evaluation should be based on fundamentals rather than price movement alone. If the core thesis remains intact, then volatility becomes noise rather than a signal. If the thesis has genuinely changed, then adjusting or exiting a position becomes a rational decision rather than an emotional reaction. Another practical approach is focusing on process over outcome. No one controls market direction, but investors can control behavior. This includes setting rules in advance, such as allocation limits, rebalancing schedules, or predefined time horizons. Having a process reduces the influence of fear and impulse during stressful periods. Decisions made calmly ahead of time are usually better than those made under pressure. Long-term thinking also benefits from zooming out. Short-term price action can dominate attention, but broader trends often tell a different story. Looking at multi-year adaptation, technological development, and macroeconomic shifts provides context that daily charts cannot. This perspective helps investors avoid overreacting to temporary conditions that feel urgent, but may be insignificant over a longer time frame. Liquidity management is another overlooked aspect. Keeping some capital uncommitted provides flexibility and psychological comfort. When all capital is fully invested, every price move feels personal and threatening. Having liquidity allows investors to respond thoughtfully rather than defensively. It also creates optionality, the ability to act when opportunities arise rather than when fear dictates. Ultimately, navigating periods like this is about aligning behavior with goals. Investors who seek short-term gains will experience stress and long-term volatility, while those with long-term objectives must accept discomfort as part of the process. Markets are designed to test patience and conviction. They reward discipline slowly and punish emotional decision-making quickly. In an environment filled with noise, the most effective strategy is often the least dramatic one. Stay informed. Stay rational, manage risk deliberately, and allow time to do the work that emotion cannot. Because lasting results are rarely achieved by reacting to every headline, every price swing, or every moment of doubt that appears when markets feel most uncertain. So where does that leave us? Not with certainty, not with easy answers, but with clarity. Bitcoin isn't being tested because it failed. It's being tested because the environment changed. Liquidity tightened. Institutions pulled back. Fear filled the gaps left by confidence. And in moments like this, markets stop rewarding excitement and start rewarding discipline. This is the phase where noise is loud, emotions run high, and conviction gets uncomfortable, where prices move faster than fundamentals and narratives shift faster than reality. It's also the phase that quietly separates reaction from strategy. You don't need to predict the bottom. You don't need to time the next rally. What matters more is understanding why things feel heavy right now, and making decisions that align with your risk tolerance, your time horizon, and your original reasons for being here in the first place. History shows that markets don't break when fear shows up. They break when discipline disappears, and they recover not when headlines turn optimistic, but when excess is cleared and patience returns. So whether you're holding, reducing risk, or simply watching from the sidelines, remember, T's volatility is not a verdict. Pressure is not the end, and uncertainty is not a signal to abandon a plan that was built for the long term. In markets like these, doing nothing can be a decision. Waiting can be a strategy, and staying rational can be your biggest edge. Because when the noise fades, it always does. What has left eisen? Fear or hype. It's the quality of the decisions you made when clarity was hardest to find.